There is so much to digest in Peter Lynch, One Up on Wall Street, a book originally published in 1989. The book is easy to read or listen if you prefer audiobooks. There is a section within the book that focuses on the advantages of amateur investors versus professional investors.
Jeff, look, I love that at 40, the chairs move, pal. I want to know if we're part of it. We better be, and I'm gonna come down and eat your lunch for you.
To understand the advantages over Wall Street, you need to look at the minds of the people in the industry. They all read the same newspapers, listen to the same economists, and follow the same trading software signals. They're quite a homogeneous lot.
Homogeneous. Homogeneous. You idiot.
You won't see too many ex-surfers, Uber drivers, high school dropouts, or working class bachelors.
So how many people have you talked to about this trade?
Under this current system, a stock isn't truly attractive until a large number of institutions have recognized its suitability.
You smell that? What is that?
Opportunity.
No, money.
But by the time they have labeled it a buy now, the opportunities have passed. It is the rare professional who has the guts to traffic in an unknown stock.
Requesting information on penny stocks that had huge upside potential with very little downside risk. Does that ring a bell?
Success is one thing, but it is more important not to look bad when you fail. No fund managers will lose their jobs making bad investments into well-known and established companies like Amazon.
Turning to the stock market, Animotion is up an eighth. Yes! After plunging 75 points this morning.
Oh, I hope plunging means up and 75 means 200.
But if your relatively unknown company goes bad, they'll ask, what's wrong with you? Fund managers spend a lot of their time talking to clients about the decisions they're making. First, they need to tell their immediate boss in their department. Secondly, they need to tell their ultimate boss, the clients.
Right. But if you can make clients money at the same time, it's advantageous to everyone, correct?
And the bigger the client, the more talking the portfolio manager has to do to please him or her. Some stocks require very little explanation, but others are much more questionable.
From school, Steve, man.
Right from school.
Women's shoes.
Women's shoes.
Women's shoes.
That's why security-conscious portfolio managers miss the shot at snagging the 10 baggers, or a stock that goes up 10 times. Instead, they'll wait until the analysis pile up on it. By definition, their results are going to be mediocre. But for most expert investors, acceptable mediocrity is far more comfortable than diverse performance. You don't have to invest like a big bureaucratic institution. If you choose to invest like one, then you're doomed to perform like one. If you're just an average person in the world, you'll have an edge already. There is no rule prohibiting you. Nobody is calling you out for buying back stock at $19. You're not forced to own 1,400 different stocks. Peter Lynch's best investments weren't made in the times where he was doing a complex analysis, slamming away at the computer. His best investments were made living in normal day-to-day moments.
Your philosophy is simple, and I'm remembering this from the previous book. I think we're now talking about the previous book.
Correct.
Your philosophy was, if you find something that you identify with. I remember there was a story of your wife and her hose. Your wife kept saying, these are
oh, you
legs,
got it. Yeah.
Legs and panties. Your wife said, these are the greatest things I've ever seen.
Right.
And when your wife said that, you knew that this was a product that was better.
Right.
You used to stay at La Quinta Motel.
Right.
And the service was better, whatever was better.
Right. The price was good.
And the price was good too. And you said, this is a place that I can determine. I, Peter Lynch, can tell that this is a good product, right?
That's right.
And if these people make it a good product, then their earnings are going to go up, therefore the stock's going to go up.
Right.
And that's the kind of decision-making process you ought to go through.
Right.
Do I have it?
You've got it exactly right. Well, I don't think people understand there's 100% correlation with what happens to a company's earnings over several years and what happens to the stock. If the company, McDonald's has done very well as a company,
right,
the stock has done very well. People worry about too much money supply, what's happened to the price of oil, who's the president, who's being nominated for the Supreme Court,
It's all
the
earnings.
ozone layer. There's nothing to do. McDonald's earnings go up the next 10 years, the stock will go up.
A lot of women play tug of war.
His best investments was made in Lynch, which was a consumer product in the 1970s. Whilst Peter was going hard calculating the PE ratios and doing quantitative analysis on different companies, his wife found Lynch in the grocery store.
Tug of war. Get new Legs Classics.
His wife knew straight away that it was a superior product. How many of the women who bought pantyhose, store clerks who saw them being purchased, and husbands who learned of them when their wives returned home with their superior stockings could have predicted the success of Lynch? Absolute millions, that's how many. Just 2 or 3 years after it was introduced, thousands of supermarkets had it. Luckily, Peter did some quick research after his wife bought some home, and he saw the fundamentals made sense. Everyone else was too busy buying what was published in finance magazines and websites. One of the best performing stocks on the Australian Stock Exchange in 2019 was Afterpay.
Cash credit or Afterpay?
What's Afterpay?
Wow.
It went public in 2017, initially at $3 and reached $100. In the first few years, hundreds of thousands of customers jumped on the buy now, pay later service.
Josh, I've seen what you lick and it's way worse than this.
They would have seen the utility before the stock was on the radar of the professional investors. If one of those 20-year-olds bought $200 of stock instead of the $200 pair of jeans in 4 equal payments, they'd now be sitting on over $6,000. If there are some things you are sincerely interested in, whether it be cars or cameras, you develop a sense of what's good and what's bad.
What's this?
Your food.
You know what sells and what doesn't. In some contexts, you know it before Wall Street knows it. And you have the opportunity to jump on before the investment banks begin to recommend the stock. The analyst only notices the stocks after they've jumped from $3 to $30. But you're able to notice the stock at $3. As an amateur investor, you might think it isn't sophisticated practice buying the new pair of jeans with the buy now, pay later system as the initial phase of an investigation into stocks. It isn't difficult or sexy enough. But this is an edge that professionals simply don't have.
I'm saying people have natural advantages.
Yeah.
Let's say what you do for a living is you're involved in the restaurant industry.
Right.
You supply paper products. You supply kitchen equipment. You help build restaurants.
Right.
You saw McDonald's. You saw Chi-Chi's. You saw Chili's. You saw Cracker Barrel. You saw Dunkin' Donuts, Kentucky Fried Chicken, Taco Bell.
These are all success stories.
These were 40-fold. You made 40 or 50 times your money. You don't need to make that kind of money many times in your life, right?
Yeah, no.
That's all you had to do was follow the restaurant industry.
Yeah.
People are in industries. They're in the publishing industry. They're in the chemical industry, the paper. Why don't they just stay with that industry? You only need a few stocks a decade. How many good stocks do you need a lifetime? Instead of people, they're in the restaurant industry. They're buying biotechnology stocks. Right. The people in the chemical industry
nothing about
know nothing
biotech.
about it. The people in the chemical industry are buying oil stocks.
Right.
It's absolutely absurd. People don't understand their natural advantages, and they don't use them. So that's bad, number one. But worse, number two, is if you don't think you're a good ice skater, or if you're convinced you're not a good cellist, you're not going out and try it. But people are buying stocks anyway. Yeah. They're not discouraged. They just think it's a gamble. Yeah. So therefore, they go forward and they bet on one stock for a week and a half, and it goes up, and they make $2 on it. Then they sell it, and they buy something else. When 3 years is over, all they've done is generate a lot of commissions, and they've probably lost money. That's a mistake.
So your advice is what?
If you don't understand a company, if you can't explain it to a 10-year-old in 2 minutes or less,
yes,
don't own it. Because when it goes down, let's say the stock goes down 2 points.
You won't understand what's going on.
What do you do? Do you buy more? Do you flip a coin?
And chances are your broker doesn't either?
He or she certainly doesn't know about it. I mean, who knows what all these things are with auto back planes and mega flops.
Guys, comment below on what is your favorite stock at the moment for an opportunity to win 0.001 Satoshis. Satoshi. Please note, you do need to have a crypto wallet for this to work for you.